In this section, we're looking at how to calculate the cost of inventory, and this is when inventory is sold to customers. So we actually have to calculate this, and we have some different methods here that we can choose. First in, first out, also called FIFO, last in, first out, LIFO, and then also average cost. Okay, before we dive into calculating the cost of inventory under those methods, FIFO, LIFO, and average cost, we can take just a second to ask, what is the purpose of doing that? And don't be intimidated by all the words here. You're going to see a picture of this in just a second. That'll make it make sense. But just to get us started, I'll read this. A company begins each period with a dollar amount of beginning inventory cost. The company adds to this cost during the period with inventory purchases. At the end of the period, the cost of beginning inventory plus the cost of purchases is known as goods available for sale. Of this total cost, a quantity of inventory is sold and a quantity is still on hand. The purpose of inventory costing methods is to calculate the dollar amount of inventory that has been sold and also the dollar amount of inventory still on hand. So now we have basically a picture of why we need inventory costing methods. If you forget about everything below the black line for a moment, and we just start up top, we start with beginning inventory that we started the year with. We had 100 nails. They were $5 each. Throughout the year, we made purchases of more nails. We bought 50 nails at $6 each, 40 nails at $7 each, 60 nails at $8 each. And then if we add together the beginning inventory with all the purchases we made throughout the year, we have something that we can call goods available for sale. And the total dollar amount here is $15.60. Now, imagine that all of these nails we just dumped in this bucket here, and that throughout the year, customers came by and they purchased some of these nails from us. They just reached into the bucket. Customers purchased 215 nails throughout the year, and we had 35 nails left over at the bottom of the bucket at the very end of the year. Now the question is, what is the unit cost per nail? So of the 215 we sold, what should the unit cost be? Should it be $7.15? Should it be $7.80? That needs to come in here so that we can calculate what was our cost of the goods sold. To calculate the cost of the goods sold, we'll simply take the 215 nails, multiply it by the unit cost per nail, and we'll have cost of goods sold. Likewise, down here, the 35 nails we still have at the end of the year at the bottom of the bucket, what should that unit cost be? Should it be $6.50? We've got to calculate that, and then we'll take the 35 nails, we'll multiply it by the cost per nail, and we'll know how much ending inventory we have at the end of the year in dollar amount. Well, the first inventory costing method is actually the simplest, and that's the specific identification method. So as the first bullet here says, the cost of goods sold for any given inventory item, such as a car, equals the cost paid to acquire the item. So this is going to be used by businesses that sell unique items with very different costs. For example, autos, homes, artwork. And to use this method, each of the items, they have to have a unique identifier, such as a serial number or a unique asset number. And all we do is when we sell the item, we look back to what did we pay for it, and whatever that amount is, that is what we record as cost of goods sold. Now we want to look at a very popular inventory costing method known as first in, first out, or FIFO. As the first bullet says, FIFO assumes that the first items purchased are actually the first items to be sold. So you can think of milk at the grocery store. They're going to load the milk in to the refrigerator, and the first ones that they load are probably going to be the first ones to be sold. So in this example, however, we're using 4x6 red picture frames, and we're going to start here at the top, January 1st, and we start with beginning inventory, a quantity of $5 for that frame, so we had a total cost of $5. Now, on the 5th of January, we actually purchased 2 more frames. These are $6 a piece for a total of $12. And so, as we discussed earlier, with a perpetual inventory system, we're going to keep a running total of our inventory on hand, and that is over here, these 2 lines. These are also called inventory layers. So the first layer was that 1 frame at $5, but then we have now this new layer, 2 frames at $6 each. So here's where the first in, first out method comes into play. It's when we sell one of the frames. On January 10th, we sell a frame, and the question comes in, what is the unit cost? And theoretically, we could say that the unit cost was $5. We could say that it was $6, or we could say it was something in the middle. We have to make that decision, and that's the decision we're making when we select an inventory costing method. First in, first out says, well, the first one that we got in was $5, so we're going to assume that the first one we sell is the first one we got in. So we just take the 5 and we use it down here. So the inventory that's on hand at the end of the period, we're going to assume that it's the 2 that cost us $6 a piece. Now we can also choose an inventory costing method known as last in, first out, LIFO. And as the bullet here says, LIFO assumes that the last items purchased are the first items sold. So you could think about that bucket we had earlier with the nails in it. If upon each purchase, we just dump the nails that we purchased from our supplier into the bucket, well then it would hold that the first items sold were actually the last items that we purchased. In this case, we're talking about red picture frames, and the table is almost identical to the previous table for FIFO. The only difference comes into play January 10th when we sell that 1 picture frame. When we're asking, well, what was the unit cost that we should use for that frame, we're actually going to look at the last instead of the first item that we purchased. The first item that we had on hand was this one here for $5, but the most recent, or the last item, is this layer here, the 2 frames at $6 a piece. So since we're using LIFO, we're going to take that $6 and use it for this sale to calculate this cost of goods sold on January 10th. So if we use that 6, what we have on hand January 10th is actually the one for $5, and then we have one of them for $6 that's left over as well. Now the last inventory costing method we're going to look at is called weighted average method. As the bullet here says, the weighted average method calculates average cost per unit after each purchase. And this average unit cost is actually used to calculate the cost of goods sold when we sell items. So the table is different from the table in LIFO and in FIFO. What we do actually is on the 5th of January, when we purchase those 2 frames for $6 each, we go over here to our running record of inventory on hand and we say, what was the total cost that we paid for all 3 frames between the beginning inventory and the January 5th purchase? Well, that was $17. How many units do we have on hand? 3. So if we take $17, divide that by 3 units, then we have an average unit cost of $5.67. With this method, that's exactly what we use on January 10th when we sell the 1 frame. We just use the average unit cost. So there it is. And interestingly, the cost of goods sold is based on the average unit cost, but also the 2 that we have left over are based on the average unit cost as well.